Good morning. Welcome to Stock Market Today. It's Thursday, March 19th, 2020. Happy St. Joseph's Day to the Italians out there who are listening today. I am Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can find me on Twitter. I'm at Dan Russo _ CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email where we get a lot of the content for this show, as well as give you daily stock ideas to consider. Stress consider in your inbox every trading day before the market opens. So U.S. equities finished lower in Wednesday's trading after triggering another circuit breaker when the S&P 500 fell by 7%. In a small victory, equities rebounded into the close to finish above the 2018 lows. Energy and industrials and financials continued to underperform. Comm services and staples were the least bad as all sectors closed lower on the day. Treasuries were weaker, curves steepened. 10-year yield moved back above 1%, violently so. The dollar extended its recent strength, hitting 3-year highs. We talked about how cash is king yesterday, and that remains the case. Gold closed down 3%. WTI crude remains under extreme pressure. And as we get to the desk this morning, futures are down about 2% in volatile trading. Asian markets were mostly lower overnight. European markets are moving higher. ECB stepping up to the plate here this morning. Treasuries are stronger across the curve. The dollar is stronger against the major crosses once again. Gold is up 30 basis points and WTI crude up 12.8% after falling a similar amount on the day yesterday. So big story yesterday from a technical perspective for the S&P 500 is that we held the December 18 lows after a brief undercut, right? It's a small victory, but we have to start to take the small victories on the bullish side of the coin where we can. Should that level break, we have to really start thinking about the 2000 to 2100 level to the downside. 2100 being roughly the breakout area. In 2016. RSI continues to hold in bearish ranges despite no longer being oversold, and Chaikin money flow is, let's call it neutral at best. A bit of a bearish tilt here. So these are, the levels are the levels, right? In a precipitous downturn, the market really doesn't respect the support levels that you think. We really need to see sentiment start to change. We talked about sentiment yesterday. We'll talk about breadth today, as we always do on Thursdays. So for us, we're not sticking our hand out there and catching the knife. We're going to wait for signs of diminishing selling intensity before thinking about even sounding an all clear at this point. So our market in a minute. What are we writing today? All sectors closed lower. So the S&P 500 made a new 52-week low yesterday. We hit on that. Small cap carnage has been more severe. The IWM is off 40% from the highs. We've been talking about the underperformance. We highlight it pretty much every day over here. And, just putting it in perspective, major markets down around 30, small caps down around 40. Breadth remains at washed out levels, but we're still looking for less intensity. Global stocks undercut their 2016 lows, right? So while the market's holding above the December 18 lows, global markets have really come under immense pressure, having gone now below the lows from back in early 2016. And as I said, futures do point to a lower open today in volatile trading. Actually came close to being limit down at one point. Turning now to the power bars for the major indices, still a lot of damage out there. 0 bulls to 4 bears for the Dow, which was down 6.4% yesterday. S&P 500 down 4.6% after being down nearly 10% or right around 10% earlier in the day. 3 bulls, 124 bears there. NASDAQ, as has been the case, the NASDAQ is an outperformer and remains an outperformer, right? We've talked about what outperformance means in this environment. It just kind of means down less. But down 3% when the S&P was down 4.6, 2 bulls to 23 bears there. And there's your small cap underperformance. Bonds even under pressure, right? The safe havens are under pressure as well on an absolute basis, according to the Chaikin Power Bar. Large cap stocks and small cap stocks are bearish. Taking a look now at our stock of the day, and this one is not auto-generated because there aren't a ton of bullish stocks out there. The auto-generated version of this was the same as yesterday. So I kind of went through and looked for a name that is likely to be leadership when the market stabilizes, right? We talk a lot about relative strength. Take a look at Eli Lilly here, LLY, the ticker symbol. Chaikin Power Gauge rating for Lilly is bullish due to very strong earnings performance, very strong price volume activity, positive expert activity. Does have very poor financial metrics, but when we take the 20 factors, we get a bullish rating. Now, we're actually in a strong trend, right? Can't say that about a lot of stocks, but Lilly remains above this still rising long term trend line as it consolidates here. Industry is weak, but that's based on power bars. All of the industries are weak. But look at the relative strength, right? This is the key to finding the potential outperformers once we do base. I've said it over and over again, and I'll continue to say it because I think it's that important. Um, Find the stocks that have held up the best as the market is cratered, because those are your likely leaders coming out. I'm not saying to run out and buy Lilly today, right? I think we still need to be super selective, and Lilly is overbought here based on our indicator. Money flow is bullish, so we have a bullish stock outperforming with bullish money flow above a rising long-term trend line. It is overbought. But I think Lilly is a name you have to have on a bullish watch list. I've been telling people, I continue to tell people, stay engaged. It's hard. You want to kind of crawl under the desk in an environment like this. I don't think that's the right move. Stay engaged with the market. Build watch lists. Look for names that have relative strength. Look for names that have the potential to be leadership once we begin to stabilize. Lilly fits the bill there. Taking a look at our sector tracker now, moving to the major sectors over the last 5 days, still very defensive at the top of the list, right? Staples have come on strong, right? A lot of the food retailers in that group, a lot of the drug retailers in that group have held up best. Very much a safety trade as far as I'm concerned. Healthcare, another area of the market that's out, it's outperforming. I mean, down 8.8%, but it's still outperforming. Utilities, obviously, the flight to safety playing out there. And we like to see tech near the top of the list as it is the largest weight in the S&P 500. Comms, materials, fins, and industrials in the middle of the road. Real estate under a lot of pressure. Big bifurcation going on in the real estate market right now, where you really have to differentiate. Hard to say markets under pressure. I'm going to hide in real estate because it's a safety trade. In normal environments, yes, but in an environment where we're starting to think about credit quality, in an environment where we're starting to think about people being able to meet their interest obligations, real estate, you really have to parse that group really well. Discretionary, obviously, under a lot of pressure, stores closing, restaurants closing. I mean, we don't have to go through it. We can all read the news. And energy, I said all there is to say about energy. I still pay attention because I want to find an opportunity there, but it doesn't exist at this point. Changing it up a little bit today, I wanted to look at sector rotation and keep going. I love the RRG charts on the stock charts platform or any platform where you can get them, because it just kind of shows you how things are trending, right? So not only where they stand now, right? Not staples, right? But where's it come from? And what does the trajectory look like? I love the relative rotation graphs for that purpose. So as we take a look, right, for those of you who are not familiar, we put the S&P 500 right here at the crosshairs, and then look at what's leading, what's weakening, what's lagging, and what's improving. And I really think the opportunities lie when we go from lagging to improving, right, and from improving into leading, right. You can pretty much see it's what we've been talking about, but you can kind of see how fast things have moved, right? A prompt about face for healthcare from weakening back into a leading position, right? Tech remains leadership. We've been talking about that. Com services, right? Those are three areas of the market where we've been the most bullish, and we were bullish into the downturn, and those groups have held up the best. So on a relative basis, for investors who have to stay invested, that has been the right take. And what we can see here is the quick about face in discretionary XLY, and then the safety trade as Utes, Staples, and REITs, not quite there yet, but moving toward a leading position. So we wanted to take a look at XLK here. What's interesting to me is the outperformance and the fact that we are holding the lows from 2019 so far. So tech is one of the areas that we like. Turning now to what's trending, what are movers and shakers for the S&P 500? Akamai up nearly 10% yesterday. Akamai has a content delivery network, and as everybody's home and working online and kind of trying to disconnect their brains a little bit, and that's an interesting business to be. Huntington Ingalls, no real news to send that stock higher by 7%. Gilead still hopes that their drug for coronavirus could be successful. That stock up 6.5%. Walgreen Boots, part of that Staples area that we've been talking about, drug retailer, holding up, right? The companies that sell the things we need as opposed to the things we want are outperforming. Other than that, honestly, the JW Nordstrom baffles me. Maybe it's a bit of a relief rally, but up 5.5% yesterday. I didn't see anything company specific. Obviously, a consumer discretionary stock, very bearish rating. It's a name that we've been haters on for a while, based on our model. Honestly, don't see a ton of reason to get excited about it, even after it's up 5.5%. But as always, we keep an open mind. On the loser side of the board, APTV down 30%, despite an upgrade from Bank of America Merrill Lynch. They did take their price target down, however, from $90 to $63. United Airlines, we all know what's happening with the airlines. They're looking for a bailout, announced a 60% reduction in routes for April. OKE, didn't see anything there. Take that stock down by 28%. There must be something out there. I just didn't see it. Mosaic MOS 52-week low, down 27.5% on the day. And honestly, the cruise lines are just remain a disaster. A lot of volatility in the group, a lot of back and forth. But these things are essentially trading as if they're distressed assets at this point. So we wanted to talk about levels, right? We get a lot of questions and precipitous declines. Where can we go? Where can we potentially stop? And levels are just that. They're areas of interest, right? They're not hard and fast. If we hit this, we're going to stop, right? We want to keep an open mind and identify the levels of interest. And I really didn't think I'd be using 2009 as a reference point again, but here we are using 2009 as a reference point. Remember, the market bottomed in March 2009 at 666 for the S&P 500, and we've gone on this 11-year bull run. If we want to call the top back in February, the top, well, the 38% retracement is 2350, which lines up with the December lows. We kind of halted there. Should we break, though, and this comes into, we talked about 2000 to 2100 as potential next levels. This is why we have to think about that, because a 50% retracement takes us back down to 2030. So call it 2000 to 2100 for a zone of interest should 2350 break. And beyond that, I think a 61.8% retracement takes you down to 1700, which is a 50% roughly drawdown from the highs that we reached a month ago, right? It was February 19th. The S&P 500 made a record high. Now we're starting to talk about where we could go if we retraced 50%, or if we had a 50% drawdown. Well, here it is. Lines up with a 61.8% retracement level of that entire advance. Now let's start thinking about where we could go should we see a ripper to the upside. What if we bounce, right? Here are the upside retracement levels using last month's high and yesterday's low. A 38% retracement takes you back to about 2,700. A 50% retracement, 2,830, and a 61.8% retracement back up towards 2,960. It's amazing to me that we could rally, 570 points in the S&P and still very much be in a downtrend. That would be perfectly within reason, right? Based on key retracement levels. Again, these are areas of interest, not hard and fast targets, and no guarantee that anything is going to stop there. But we want to pay attention. Finally, we'll wrap it up with breadth, as we always do on Thursdays. We're at washed out levels. There's no two ways about it, but we're not seeing any diminishing in the intensity, which is what we're looking for. Percentage of stocks above their 200-day moving average, still less than 10%, made a new low last week. Percentage of stocks above their 50-day moving average, right around 4%. Same goes for the percentage of stocks above their 20-day moving average, right at 4% as well. So what we'd be looking for is, for these metrics to do one of two things. Rally with the market and then make a higher low on a subsequent retest, or should the market just keep going? Once these things get back above kind of the 30 level, starts to be a little bit more interesting. So I'm going to wrap it up there. Head over to chaikinanalytics.com/test drive. Sign up for a 14-day trial. I'll be back with you tomorrow.